First rates any second now, and any seconds now you've got, well, it's a flat start for the Nifty, it's a flat start for major indices. That really is immaterial right now. What is material is the Sensex-Nifty are consolidating. The breadth of the market is looking near perfect. Adani group of stocks, they continue to add elevation, and frankly oil marketing companies are looking solid after 2-3 days of solid comeback. But where is Paytm? And what about some of the unsecured lenders? Largely Aditya Birla, 20% down. Just gone to the cleaners. I mean, 20% down for Paytm. Just look at the cut. 20% means that 20% of the market cap has got just eroded for Paytm. And why? Because they've just come out and said the obvious. I'm surprised that market has taken so much of time to react to it, but it is like a someone's come and poured really chilled water in a stock where there was strong momentum. And now what happens? Assumptions and the positioning and everything changes. But what about Aditya Birla Capital? The rub-off effect of that could be visible in L&T Finance. The rub-off effect of that could be visible in Piramal. And there you go. The rub-off effect of companies which have unsecured loan book or large dependence on unsecured loan book, that now clearly seems to be impacting the market per se. But the story really is Paytm, 20% down.
Yeah, it's quite a shocking move actually. 20% lower, and it's slumping even further. 650 is where that stock is. Although I think there should be filters which should be kicking in soon on Paytm. Also want to see that Airtel as well as IDFC First, what both those stocks are up to, because there is speculation that Warburg Pincus is looking to raise about $211 million via block deal on Bharti. So Bharti will just come up for you on your screens, and it's a 3.25% downtick that you're seeing currently on IDFC First, because there too there is speculation that Warburg may be selling 1.3% stake via block, and the floor price has been set at $85-70 bucks. BEL, a sizable order from the Indian Army for AMC of radars, 580 crore rupees. That's how sizable the order is for BEL, so look out for that. Ircon is the other stock which is in focus. There's an 8% stake sale that the government is looking via the OFS route. The floor price has been set at 154. Ircon gaps down about almost 8% as we speak right now. Also, crude has managed to see a very steady decline for a fifth consecutive day, and I'm sure that's auguring well for the likes of HP, BP, IOC even further. Solid moves on all these three stocks to start off trade. Maybe not all that great for ONGC and Oil India. Stocks also will just come up for you on your screens next. Besides that, there's not much of news flow. Yeah, sugar is the other one, wherein reports are indicating that the government may be looking at curbing the use for ethanol. So that could be the other stock to look out for. And perhaps, Unilever too, like we flagged off that Macquarie note, wherein Q3 volumes are seen at 2 to 3%, although they maintain that outperform rating on Unilever still. But yeah, it's a bit of a tempered start and very news-specific a start as well, Kunal.
Yeah, I think we needed that break for the indices. Maybe a few days of consolidation would probably be considered to be healthy for the index as such. TCS is something which I think yesterday gave a strong breakout, and in terms of the opening trade, that's a stock which I would look to pick at current levels.
Okay, that's TCS, and Kunal believes that there is merit in buying into some of the large cap IT names. What about you, Naresh? Is it still with financials?
So I go with Maruti. That is the one which is closer to making a breakout into a new all-time high. So this could catch some momentum over the next few sessions. So it would be Maruti for me.
Manish Sonthalia joins us. Let's say good morning and hello to him. Long time no see. How you been, my friend?
Morning, Nikhil.
So what's keeping you busy in this market? Are you just purely enjoying the market momentum when suddenly nobody wants to sell, everyone is convinced that things will look up, and just when the political picture became clear, you got a lot of support which is coming from global cues also. So it's like a picture perfect market, right?
Yeah, I mean, it's a Goldilocks sort of a scenario, but I don't think it will pay you well if you want to play a contrarian, because we are in uncharted territory. And obviously, if all the factors are positive, I mean, it works well if you ride the momentum. So I would believe that markets are still headed higher, and you got to do your stock picking within this entire setup, and that's how we are placed, I would think.
So headed higher. Why are they headed higher? One view is that FIs have not come back and they will come back. So we are looking at huge inflows of liquidity. Now the problem with that view is that everybody has the same view.
I mean, it's a question about flows, and you can't ignore India for too long. I mean, that's the entire truth. Because if the fundamentals are supportive, if the macros are supportive, both global and local, then obviously it's only a matter of time. I mean, there will be difficulty in finding good quality paper when the flows, turn positive also from the global side. So, I mean, at the end of the day, it's a bottom-up stock picking. I mean, that is how we would like to place it. I mean, there's no denying the fact that the outcome for the next many years to come is going to be positive, but it's going to be our individual stocks.
Picking your spots. What are those stocks where you think that they can still make money?
Obviously, financials are an ignored lot, and have been underperforming for some time. And of course, if the profit momentum is to happen, then financials will lead. That's one space. I would believe technology again is a comeback sooner than later. Again, valuations here are very, very palatable. We just saw the recent listing of Tata Technologies. What a euphoria you've seen. So, technology is again one area where, there will be good growth. And the third space is only a matter of time is your pharmaceuticals. Again, they will come back on a low base. So I think, valuations where these are comfortable are these three sectors which should lead from the front.
That's quite interesting, Manish. Help us understand where is it within these three sectors that you talked about do you find value? I mean, are these blanket calls in the entire sector or more a stock-specific segregated approach?
So both within the PSUs and let's say the private sector banking space, there's ample value. So within the private sector, public sector, let's say financiers, we would like the energy financiers, so the likes of let's say PFC, REC, IRDA. Within the private sector, obviously the known names are there, and you will have a blind call on an ICICI Bank being on the positive side, then HDFC Bank being on the positive side, just based on pure valuation. I mean, you can't go really wrong in these names where valuations are mid-teen types. So that's how we think it's, and again within the financials, the platform companies. So whether it be an exchange platform company or a repository exchange platform company, or let's say broking platform companies or AMCs, I mean, I would think that these are the spaces to own within the financials for the next many years.
That's quite interesting, Manish, because there is that conjecture in the market whether the meat of the rally in the power stocks, at least in the near term, could be behind us or not. But clearly, you don't seem to think so, right?
I really don't think so. When Government of India wants renewable capacity to be 450 gigawatts by 2030, and within that solar 300 gigawatts, of course, you could say that numbers are very full for the near term, but it's not about the near term. It's how far into the future can one look. So I think energy is one space which will buzz with activity. I mean, it was long said that defense stocks also were very full in valuations, but the valuations have only got richer with each passing day when you have more defense orders coming through. So, I mean, this defense story, power story is not for 1 year or 2 years, it's for many years from now.
Right, look to play some of those themes for the long haul. Manish, what about the earnings? What is it that you're anticipating in terms of earning trajectory down the line? Any specific sectors you believe could likely surprise on the upside?
I think one sector which could surprise on the negative side is the consumption space for the third quarter at least, because we believe that on our channel checks, broadly the consumer discretionary space is a bit soft post Diwali. That will actually have a rub-off impact, on the white goods space and other discretionary names for the third quarter. I think on an overall basis, an 18 to 20% trajectory is par the course, where autos are firing on all cylinders. You have financials, doing quite well. You have capital good players, which will do quite well. And I think even the pharma space, both the raw material cost on the negative side, as well as domestic inflation price linked increase, that should rub off well as far as the domestic pharma space is concerned. So I believe these are the areas where you'll find a positive trajectory on the earnings. And of course, the PSU basket is in its own trajectory altogether, both on the PSU bank side and even the other PSU names, where these names could really surprise you on the positive side as far as the earnings growth is concerned.
What do you make? What do you make of this unsecured lending red flag which has been raised by the Reserve Bank of India? I mean, banks have exposure to unsecured loans, and look at stocks like Paytm and Aditya Birla, Capital, how they're getting smashed.
I mean, it was a given, Nikunj, that unsecured credit was growing. The costs were just too high. And of course, banks used to allude to the fact that unsecured lending was just about 5% to 10% of the overall book. But of course, the next NPA cycle, according to me, is going to come on the retail side. And we have been in a very benign credit cycle for the last 3-4 years. This was too good to last. And of course, with RBI's clampdown on unsecured retail, the raising of risk weights, I mean, just one step in the direction. It's a right step, I would believe. And as far as Paytm is concerned, bulk of their loans was basically personal loans, and less than 50,000 ticket size. Of course, they are going to get hurt very, very badly on this front. Growth rates are going to plummet significantly. And even NBFCs who are financing bulk of these unsecured loans, I don't think it's going to be a problem majorly for the banks per se, because as we said that proportion of unsecured lending to the overall book is very, very manageable. But the NBFCs are going to be at the front. And of course, let's say in the case of Paytm, if you were to shift from personal loans to merchant loans, there the spreads are not that big. It's lower than your personal loans, so it's not as profitable as your personal loan segment. And to move the needle away, the mix going to change in favor of, let's say, merchant loans. I mean, that's going to have a bearing on the valuation. So, and valuations were pretty full, I would believe. So, that's how I would look at it. Very careful with the NBFC space. Not so worried about the banks per se, particularly large banks. But yeah, smaller banks catering to business loans, or loan against properties, I would tread with caution.
Manish, just tactically, in the very near term, would you say that the meat of the rally at an index level and downwards is going to play out from now up until the 2024 elections?
Of course, I mean, as I said that, if you have all the factors actually turn in positive, and it's a very, very broad-based rally. You can't really segregate one sector vis-a-vis the others, barring, let's say, a specialty chemicals, which is going through its own round of destocking and so on and so forth. But I think, the rally is very, very broad-based. Sectors which have not participated previously in the rally so far will have valuations come forward, so they'll play a catch-up game. I mean, who could have imagined that, let's say, an HPBP suddenly become the flavor of the market? You have seen stupendous rise in the oil marketing company. But such is the case. There is a fear of missing out. There is a FOMO factor. And wherever there is valuation comfort, investors, both local and global, will latch onto it because, India is an unavoidable market at all. I mean, now.
That it is. And seems like across the world, we are perhaps one of the top choices when it comes to alpha opportunities. Manish, great to have you on the show. Thank you so much for taking the time out and joining in. Okay, let's move on. Let's just revisit what the market has settled in at. Definitely today is turning out to be one of those days when we're consolidating, and that's okay. That's only healthy, par for the course. We've had 7 days of a heady run up in the market, and of course, it's history how this week has turned out to be. So 20,856 is where we're currently at. I want to revisit what Paytm is up to and where that stock may have settled in at. It was almost a 20% gap down, and I don't think you're seeing any signs of a revival there. Still lower by about 18% as we speak right now. There's, of course, Bharti IDFC first after those block deals that have happened on those stocks. Reports indicating that Warburg Pincus could be the seller. Recovery coming in on Bharti. IDFC first still languishing, 3.6% lower as we speak right now. And BEL is the other one after that sizable order from the Indian Army. And that's the other one which is currently in focus. But let's shift focus and let's talk about really what's happening within the fertilizer space. What are the dynamics looking like? China, remember, has been mulling a quota for urea exports in 2024. Where's the China story playing out? What are the demand internals back home looking like? We have with us Mr. S. Nand, the advisor technical at Fertilizer Association of India, joining in on the show right now. Mr. Nand, good morning. Great to have you today on ET Now. Help us understand what the construct of the fertilizer industry here in India is looking like, both in terms of demand and supply.
Well, as far as production is concerned, this year we are, we have seen growth both in the major products of urea as well as DAP. The demand is also has picked up during the data available from April to October, and the November data is still to come in, but we expect a growth of in urea. Little 1 to 2%. Similarly, there will be growth of 3% in demand or for DAP. But as far as supply is concerned, we are on track. As I said, production for urea is higher. This year, we might achieve about 31 million tons of urea production. And the demand is likely to somewhere about 36 million tons. Similarly for DAP, so there will be, and there have been, import of 3.8 million tons so far as far as urea is concerned. So on balance, this is about 1 to 2, about 2 million tons gap, which is, again, we will be filled up by imports. Similarly, there will be 1 or 2 million ton gap for DAP, which again will be filled up for the balance of the year or for the Rabi crop.
Why is the fertilizer demand, which is an indication of crop and growth on agriculture and GDP, is growing at a rate which is half that of GDP growth? I mean, normally it should be in and around the GDP growth, to put a very simple thumb rule.
See, if you see you have to take a data for about 3 years, whenever, or 3 to 5 years, because the data coming for actual consumption, there is always a time lag. What data which we have for the current year, for example, is for sale. Now, the inventory at the farmers level or inventory in the, in the channel, or all these things do matter. And demand for last couple of years has been quite high, and this year demand is reasonable. It's always we expect about 2% of growth in demand in terms of nutrients. So that is very reasonable. This, as far as GDP relationship with GDP is concerned, I don't think there is a direct relationship with any GDP, because it depends on what is the response ratio when you apply a unit of nutrient, and GDP comes from the as well as the yield as well as the price of the product, final product.
About same time last year or 6 quarters ago, the concern in the world was that Russia had pulled the plug on the entire phosphate supply. That was having an impact on the way how the entire fertilizer sector would move, in, especially in the area of phosphates. That led to a sudden price appreciation and government had to kick in. Has that situation normalized according to you?
Well, as far as urea is concerned, we will, as I said, 2 things have happened, 2 positive things have happened. One is that our production has gone up, and we are getting a full year production now from the new plants which were commissioned last year or year before. and the international prices have stabilized, yes. As far as phosphate is concerned, that it still remains a difficult situation because of, as you have rightly mentioned, and China had, had the export restrictions. So that is why after the sort of crash in phosphate prices of DAP, it has still again gone up quite a bit. But as I said, supply situation is fine, but it will have impact on final subsidy.
Right. Morning, and I wanted to get in a sense from you as well as to what the outlook is in terms of the demand for the current Rabi season and whether or not you're anticipating any more subsidies for fertilizers this Rabi season.
As I mentioned that, there will be 1 or 2% increase since last year in the Rabi season. Is always, when you have the season-wise data, how much is bought sometimes, the last month or so, or the initial period of the next season, which is Rabi season. So that is the supply situation as well as demand are quite normal. There is nothing unusual about it this year compared to what we faced in 2021 or 21-22. But now, as far as as I said, the price concern is there. But there may be some, some increase from the allocations which was made of 1.75 lakh crores. And government has already, making provision for more than 13,000 crores additional fertilizer subsidy. So that we should be there only because of the two reasons. Fertilizer subsidy remains little higher. One is the gas price, which is impacting the cost of production of urea. And the other, of course, as I mentioned, the DAP prices have again escalated after, touching the bottom a few months back. But it's not going to be a haywire or anything. There may be only a marginal increase, whatever has been provided and whatever government is already making provision yesterday itself in the parliament.
The government, in a sense, wants to reduce the dependence on urea. Enough and more work has now come from experts which say that long-term usage of urea is something which is having an impact on production, quality of soil, etc., etc. Do you think we could be in for a resistance coming from everywhere now for urea production and urea consumption?
See, urea production, as I said, we will touch this year 31 million tons. But normally we should expect about 31 to 32 billion tons with the present capacity. Capacity, as you know, has been enhanced. We had 25, 26 million tons earlier. Now it will be about 32 million tons. As far as demand or consumption is concerned, see, the overriding factor is proving to be farmer's price. And you all are aware that farmer is paying about only 20% of the cost of production or imports. It's not that our domestic production is more expensive or imports are cheaper. We always remain very competitive with imports, but the price for the farmer, which is proving to be overriding factor, and that's why we have been saying, as far as industry is concerned, that it should also come under NBS policy, which is applicable for phosphatic and potassic, so that interproduct distortion is not there. Nitrogen, whether it is through NP, NPK with complexes or through DAP or through urea, should cost same to the farmer. And so that will be one. But government has been, of course, making other efforts, and industry also has been making efforts for educating the farmers not to apply nitrogen disproportionately in excess, which is the case right now. When I say in excess, I say the ratio is in highly favor of nitrogen vis-a-vis phosphate and potash. So if it is brought under NBS and the the farmers' prices remain adjusted, in right ratio, I'm sure that, with the either there will be a reduction in urea demand, the conventional solid urea demand, and without compromising on the yields.
Right, Mr. Nand, great to have you on the show. Thank you so much for taking the time out and joining in today.
Thank you.
Okay, that's the perspective coming in on the fertilizer sector. I just want to revisit what the market is settled in at, because we're definitely sub the 21K mark on the Nifty futures. Mild consolidation is what you're seeing. The pressure points, of course, are Paytm. There's AB Capital, which is down 5.25%. Sugar stocks are the ones which are cracking hard. So Berhampur Chini is down about 3%. Unilever is down 2%. There's ONGC down about 2%. ONGC, of course, being a crude sensitive. Piramal Enterprise is down 2.25%. On the flip side, Delta Corp, surprise, even after all that's being talked about with regards to Delta Corp, that stock is actually a buzzer today. It's holding up 2%. There's Interglobe Aviation, because of the crude sensitivity, I guess, that's holding up 2%. There's Adani Ports higher by 2%. And then BEL, after that order win, that's looking smart by about 2% or so. But we'll take a very quick break on that note. When we come back, we'll analyze one of the hottest sectors right now, power, and where is it that you should be putting your money in. Back with first trades right here on ET Now. Let's analyze one of the most talked about sectors in the market right now, perhaps power. While, of course, most of these names have already seen a phenomenal rally year to date, be it the likes of PFC, REC, and I'm talking about ancillaries here, not just the power producers. The entire sector has really been charged up. But at the same time, there's a lot of FOMO feeling as well out there. So in case you're looking at entering into these stocks now, should you be doing that at all? And if so, where is it that you should be parking your money? Who better than Nikhil Nigania, the Director Senior Analyst at Bernstein, joining in on the show right now. Nikhil, hi, morning. Great to have you today on the show. Thanks for taking the time out. Nikhil, first, give us the big picture. Why is power, along with its ancillaries, just so hot in the market?
For sure. So, see what has happened in the power sector is we have had like a decade of poor performance, right, for the sector. And now suddenly we are, two things are happening. One, we are in a tight power demand supply situation. Hence, we are seeing deficits in power. And second, at the same time, we are trying to do energy transition as well. And maybe to a third point to add to that, the receivables for the power sector companies have also improved. So hence, given these three factors, I think we are still in the early stages of a multi-year cycle in the power sector. We think some of these demand supply challenges will continue for some time. We think the receivables should stay good. And the renewable commitments, as you would have seen, 2020 have been to triple it, the capacity in renewables by 2030. So that's where we are. So it's still early stages of the cycle. And so good times, looks like good times ahead for the sector.
Okay, that's a categorical call coming in. But tell me, who stands to gain from this entire capacity addition that one is seeing right now? I mean, does the right to win stand with the PSUs or private? And should you even be making that kind of diversification or distinction?
You raise a valid point. See, in terms of how to play, there are three areas. One is the developers, then second is the equipment players, and third is the financiers. And we have the options between PSUs and private names in most of these categories. The advantages, if I talk about developers, the advantages PSUs have against the private players, especially in a sector like renewables, is renewables are a relatively simple business to execute. Hence, the biggest differentiation is the cost of borrowing, which is a clear advantage for PSU names in the sector, like NTPC, which has been one of our top picks since we initiated in August this year. So PSUs do stand to have an advantage there. And then even if you look at the power financing names, companies like PFC, REC, who are largely export to lending to the space, given the kind of loan book growth that is expected for them and the lower risk of NPAs, they stand to gain as well.
Okay. Let's understand within power producers, utilities as we call them, there are two type of players. One, those who are focusing on pure thermal like NTPC, and then you've got folks which are now moving from thermal to, let's say, other sources of energy, Tata Power. Looking at the narrative of the world where energy transition is at play, what would be the relevance of, let's say, a thermal-backed utility 3-5 years from now? Because markets will start putting a terminal value, and if the terminal value is contracting, obviously stocks will come down.
No, fair point. But we have to realize, as a country, India, we don't have a lot of natural gas. We don't have a lot of hydropower capacity, is about 47 gigawatts. We don't have a lot of nuclear either. And hence, if you talk about different times of the year, let's say the month of April, when it's peak summers, hydro generation is low, wind generation is low. How do we meet the demand in the evening times of the day at 7-8 p.m.? That is when thermal becomes very critical. I think India has realized it, and that's why the targets for thermal have been revised upwards from about 50 gigs of thermal addition in 10 years to almost 80 gigawatts of thermal addition now. So to your question, next 3 to 4 years, we don't see the relevance of thermal coming down. Actually, even till 2030, we don't see any decommissioning happen for thermal plants, or rather additions of thermal plants should continue. And the targets, as you've seen, they've been revised upwards. So thermal will be very relevant. The only risk to the thermal story, I would say, is the battery prices. If battery prices crash, then there's a risk the thermal addition might not happen to the extent envisaged. Otherwise, they are very critical for India as a nation.
Right. You know, Nikhil, while there's no doubt that this is a story which is here to stay and perhaps a decade-long story, if not beyond, but the fact of the matter is also there's only that much that you can pay as a price for value on the table. Do you think there's exuberance when it comes to the financiers? I mean, we all know what happened with the IREDA IPO. There's still a lot of FOMO feeling out there. And look at what names like PFC, REC have done. What do you have to say about that?
See, these names, I think they had a poor performance. The last decade was largely due to the loans extended by them to thermal power plants, that too by private entities. That's when the risk comes, when the government entities are lending to private players, especially in a sector like thermal, where it's a long duration project, 5 years plus. In some cases, the PPAs were not signed, the coal linkages were not there the last time. But this time, if you look at these companies, just to caveat, we don't cover these power financing companies. But just to look at, if you look at the loan book of these companies now, what's driving the growth is largely renewables. And renewables by nature are much less riskier to invest in or to lend to than a thermal plant or a hydro plant or a biomass-based plant. And hence the risk of NPAs to these entities are much lesser. We are almost seeing a catch-up game, I'm guessing, from PFC REC, which is about anywhere between 1.3 to 1.5 times book value, towards an IREDA, which is almost 2 times book value right now. And PFC RECs, for that, they do have an advantage of being a Maharatna company. They can borrow cheaper in the long term. And a lot of the loan is government to government, which is less riskier as well. So we think there's still value. There could be value there in these names, given the loan book growth and less NPA risk.
I wanted to get in your take, in light of the interest rates coming down, what exactly this means for some of the power utilities?
That is definitely a very clear advantage. So if you think about a renewable plant, especially an operational plant, for a renewable operational plant, the revenues are locked. The tariff is locked for 25 years. And on the cost side, they have hardly any operating costs. For a solar plant, for example, the only operating cost is just cleaning the solar panels, which is just like dusting and removing the dust from it. The biggest input cost for them is the interest rate, given they are typically 70 to 80% leveraged solar plant. And hence, as the rate starts coming down, automatically you should see a rise in return on equity for a renewable plant. So that's been actually one of the largest reasons why renewable companies did not do well this year, calendar 23. And if going forward, if the rates start correcting, it should definitely be a big positive for renewable companies, especially.
Right benchmark metrics to understand power utilities. Price to book is one, future rates is one, demand is one. What is the right way to look at them?
So the two most common metrics we use in the sector, one is price to book, obviously, and the second one is EV EBITDA. Basis these two metrics is where we compare in the companies in the sector. So if we talk about developers, for example, The private players are almost 3.5, 4 times book value, the likes of JSW Energy, Torrent. Then there are some which are still at lower book value, trading at lower book value, like CSC, which is about 1.5-ish. And NTPC now is almost 2 times book value. And if you look at the last power cycle that we had long back, NTPC had reached a price to book of almost 4x that time. We don't think that will happen, but there's still there is room for upside, and one could enter at dips.
So to cut the summary of our today's discussion, and for those who are watching this show, power stocks on an average have seen a 80 to 100% run up in last couple of months. That's the average. Your view is that the earnings is going to be strong, and for those who are buying power stocks now also, in the medium term, there is scope for capital appreciation because the earning is that strong.
Correct. In the medium term, we don't see the deficits, etc., going away. We see the growth being strong, and we see the returns being good on the P&L balance sheet side for these names. So we continue to be positive on the medium term for the sector.
About 3 criteria, 3 pockets in which one can really invest in the power cycle: equipment, financer, and utilities. Utilities, you like NTPC. What about financers and equipment companies? What do you like there?
Finances and equipment companies we don't cover, but finances, as I said, there is a valuation, the relative valuation play which is there, right? PFC, REC trading at a lower multiple than IREDA. So that is one potential play which is there. And on equipment names, the challenge is a lot of them have run up a lot. While usually the equipment names benefit the most in a power cycle because they are short cycle, they get money fast, they don't have the long 25-year risk, and the margins can expand. But a lot of them have run up. On the construction side, we do cover L&T, which again is a second pick after NTPC in our coverage, which does the EPC work for the sector.
Great to have you today on ET Now. And as our common friend would say, that power is clearly tick boxing all of those check marks for investment right now.
Yeah, I mean, power sector, hard to find a fault, to be honest, except probably if the demand growth next year slows down, then you could see some near-term corrections happen in the stock. If demand this year has been very strong, August, September, October, it's 10 to 20% power demand growth, which we saw this time. And if next year the demand disappoints, that I would say the only risk. Other than that, I mean, sticking the boxes in terms of demand-supply mismatch, in terms of capex intensity, in terms of improving returns and better resilience.
Right, okay, Nikhil, good chatting with you. Thanks so much for taking the time out today. Okay, on that note, we're going to take a very quick break. Mildly soft is where the indexes are. We're not complaining. It needs to definitely catch its breath, perhaps, for the next leap forward. Tata Power, since we were talking about some of these themes right now, 4% higher is where Tata Power is currently in trade. RBL Bank, 3% of an up move. BEL, 2.5% higher. And paints as a category, because of this significant cool off in crude, which is now at 69 on the WTI Brent, Berger as well as Asian Paints are both holding out very, very smartly.
It is the perfect bad.
तो कब लेना है आपको?
अरे पहले बैचलर तो बन जाने दीजिए। डिवोर्स की फाइल घूम रही है कोर्ट में, कुछ साल लगेंगे अभी।
इसलिए housing.com का हाउसिंग असिस्ट फॉर रेडी प्राइस मैच एंड वेरीफाइड बायर्स। housing.com, पोस्ट योर प्रॉपर्टी नाउ।
Back with first trades right here on ET Now. Just checking in on the markets at 20,880. That's where the index is currently at. Pretty flat when it comes to the broader universe as well. Just checking in on some of those media stocks like Network 18 as well as TV 18. Do remember, on account of the latest structure in the amalgamation, those stocks are in the spotlight, under pressure in trade today. Ircon International, Steam. You've also got an L&T Finance Holdings, which is in the red, and HUL, well, that stock continues to remain on the losers' radar. But Paytm is clearly in the spotlight today. Let's find out how some of the brokerages have reacted to the kind of commentary that was flagged off in the analyst meet, which was on the somber side. Goldman Sachs, JP Morgan, they've downgraded the stock to neutral. Morgan Stanley has an equal weight rating. Let's take it across to Vamakshi. She joins in with all the key takeaways. Vamakshi?
Well, yes, Paytm is reeling under pressure as of now, and that is because the company recently announced scaling down of its low-ticket postpaid lending business, and they will now be focusing on higher-ticket personal loans. Now, let's get a brokerage take as to what brokerages are actually saying on this development. And JP Morgan has actually downgraded its rating on this counter from overweight to neutral. They've also gone ahead and slashed their target price to almost 900 rupees per share as compared to 1,200 rupees earlier. Now, JP Morgan believes that the slowdown seems preemptive in nature. However, they do believe that this is a proactive step that has been taken by the company in order to slow down ahead of stress that could show up. And this step, in their opinion, is a bit positive, but nevertheless, they've gone ahead and cut their FY24-26 revenue estimates by around 4 to 9% and adjusted EBITDA estimates by around 7 to 34%. They believe that they will be staying on the sidelines till the impact of the credit cycle on Paytm's portfolio plays out. Apart from that, we also have Goldman Sachs, who has gone ahead and downgraded its rating on Paytm from buy to neutral. They've also gone ahead and slashed the target price from 1,250 earlier to 840, and they have highlighted that the near-term visibility for growth seems to be quite low. Now they're expecting FY25 growth dispersals to be actually flat as compared to a 37% growth that they were expecting earlier. In fact, they also believe that there could be a delay in their net income becoming positive. They expected it to become positive in FY25. Now it's been delayed by 1 year, and they're expecting it through in FY26. Apart from that, Morgan Stanley has also come out with a note, and they believe that the disbursement run rate is expected to drop in the near term. The management, however, has highlighted that there could be limited impact on the earnings as higher ticket and other loans see a pickup. And other than that, they've also maintained that they will be closely monitoring the scale up of its high ticket unsecured lending business. So given that, Morgan Stanley has maintained its equal weight rating on Paytm, but more or less brokerages like JP Morgan and Goldman Sachs have downgraded their rating on Paytm, and that is the reason you should keep an eye out on this counter. As of now, the stock is reeling under pressure.
Okay, and on that note, let's also hear it out from Mihir Vora. Where is it that he believes there's value still in the markets?
Be a little more cautious on the micro cap and small cap space, because there the velocity is too high. And then I think we should be more discerning on stock picking.
And you did speak about the capex theme as well. So is that an area where there is value? If you could just be a little elaborate a little bit more.
Absolutely. So in capex, of course, there are some fancied sectors, like now it's become fancied defense and railway, etc. But there are also the traditional ones like construction, which are not that stretched. So if we do believe that we are in the midst of a good long-term revival in the real estate cycle, for example, which is just beginning to pick up, then I think there's a long way to go for some of these construction stocks, because they are not that stretched, I would say.
Mir, they say markets always climb the wall of worry, but they come down on ray of hope. And there's a lot of ray of hope right now, which means our market's building in a lot of cheery consensus.
No, I think that at least till 2 days ago, there were a lot of skeptics.
Okay.
And there was a lot of shorts in the market. If you see the FII net shorts, they were huge. So I think a lot of the movement in the last 2-3 days you are seeing is a lot of short covering, not only by domestic speculators, but I think to a greater extent by FIIs. If you look at the index net shorts, they were almost at record levels till about 10 days ago. So that covering itself is, propelling the market. So I wouldn't say we are in a euphoric zone yet.
Why do you say that?
Because this is just the short covering. We haven't seen long build up yet.
Yeah.
Okay, now let's look at the valuation matrix. We are at about 17-18 times depending on the research report you follow. 17-18 times is in line with the averages. If you are looking at market return when markets are in line with the averages, what has history taught us in terms of next 3 to 5 year in terms of future returns?
I'd say about 12% is what one should expect from these levels. If again there is no global shock or anything like that. Yeah, absolutely.
Okay, so you should be having a positive frame of mind even if you are starting today. Yes. Let's say somebody is watching those shows, says, okay, I've seen Mir Bhai on ET now, I'm convinced that there's no bubble in the market, I'm starting investing in large cap stocks.
Absolutely.
You think that a 12 to 15% return is something which is a high probability case, it is not like a out of blue event.
Absolutely, because if you look at the rolling returns history, there have been very few instances where 5-year rolling returns are negative. And almost nil when 10-year returns are not that great. So the longer you kind of take a call, the surer you are of your returns.
Okay. So maybe
In
you
fact,
talked
sorry,
about-
just to,
No, go ahead.
in fact, I also did a study on long-term returns if you had invested at all the peaks. So if you had invested at the peak of 2008 or if you had invested at the peak of 2000 and still waited for 10, 15 years, the returns are not that great, not like 14, 15%, but they're still 8, 9%.
Yeah.
CAGR, you know.
Oh yeah, 2008, what was the index level, Nifty, the peak?
Absolutely.
No.
It was hardly like, okay, 8,000?
Nifty was about sub 10,000.
Sub 10,000.
8,500 or 9,000 you peaked
exactly.
out and you
Yeah, so
almost
you're
came.
still sitting on a decent
Exactly.
return.
But that's the nature of the market, you know, Aisha. I mean, look at the peak of TMT versus the return by the time 2008 bull market peaked out. Peak of the next peak, in a sense, I would say happened somewhere in mid-cap stocks in 18. From there to now, that's the nature of the market because the economy is expanding, GDP is expanding, so that is at play.
The base continues to bloat
base
up.
is expanding.
But you talked about construction. Where are the other pockets of value right now?
I think the banks and financials are still undervalued, considering that we are in a Goldilocks situation, low NPAs, credit picking up. So far, it's only been retail, but now even corporate credit should pick up. So there's a long runway of credit growth with a clean balance sheet, under leveraged balance sheets for the NBFCs also. I would say financials do offer a lot of value. Some of the insurance companies also offer good value because they've also underperformed for quite some time. And even asset management and capital market plays, for example, you know, we have seen AMCs underperform because of, you know, I would say margin issues or concerns about future margins. But I think that also seems to be stabilizing. So there are pockets of value in financials, I would say. And the other underweight, other underweight sector is pharmaceuticals. I think we're just beginning to see the cusp of a recovery, a structural recovery in the generic bulk drug and API segments. So there, I think exports should now again become the story for the next 3 to 5 years.
IT services continues to be an avoid?
Avoid in the sense it will come back to its old growth rate of 10 minus 1 or 2% kind of a thing. I don't see secular. So if you're bullish on the domestic recovery, domestic capex spending, then this will be more of a defensive, like a mature FMCG stocks.
All right, let's get a move on then and focus in on another corporate voice, this within the primary markets, and that's DOMS Industries. It's a stationery company coming out with the 1,200 crore rupee IPO that opens for subscription on the 13th. Santosh Rasiklal is the managing director and Rahul Shah, the CFO, joining in on the show to discuss the growth prospects and much more. Good to have you both on board, gentlemen. Thanks so much for taking time out. Rahul, let me begin with you. Let's just understand the rationale for the IPO in terms of how the proceeds really are going to be applied. What's the overall guidance?
Nothing else. This is a 1,200 crore issue, out of which 350 crores is going to be a primary raise, and another 850 crores would be a OFS by the promoter. By the promoters, out of the 350 crores that we intend to raise through this book building process, 280 crores would be for setting up our manufacturing facility at a recently acquired land, and another 70 crores as general corporate purposes.
Try and fix your audio issues there and just get back to you in a second from now. But of course, DOM is what's on our focus. You know, the IPO price band has been set at 750 to 790 rupees per share. 13th to 15th are the IPO dates. The fresh issue stands at 350 crore rupees and OFS of 850. You know, it is a stationery and art product company. They've marked their presence in over about almost 40 countries. They've tied up with select entities of FIIs as well. So they are indeed seeing strong growth, multi-channel distribution network as well. And 32% of their total revenues, by the way, comes in from wooden pencils too. But Santosh, please carry on. You were making the point about the rationale behind the IPO.
So yeah, like we mentioned, the IPO is, you know, we're going to 350 crores as a primary issue. Out of this, 280 crores is going to be used for as a capital expenditure for the recently acquired land, where we are setting up a manufacturing unit, which will be for business. You know,
Of an issue with respect to the audio, but just garnering some perspective there from the management of DOMS. Do remember, as they said, this is a combination of an OFS plus a fresh issue. All right, let's move on then. And we have the management of CCL products here to understand a little bit more about the coffee industry and the supply concerns, as well as whether or not your next cup of coffee is going to get pricier. We've got Srishant Challa, who's the managing director at CCL Products, now joining us on the show. Thanks so much for taking time out, and let's get straight to it. The morning cuppa, Robusta coffee prices are near 30-year highs. There's concerns on production. So what exactly is the current on-ground situation when it comes to the supply from Vietnam and the Brazilian exports for Robusta?
So the news that we have at the ground level is that there is going to be a 10% shortage in coffee from Vietnam. Indonesia also, the climate is not looking really good, so there's some expectation of shortages over there. But on the plus side, Brazil has a really good crop that has come in. It's just that the farmers are not willing to sell at anything lower than the current terminal market prices. So that is also creating a kind of an artificial demand for the coffee, which is why the prices are still remaining high. And within India, we're getting coffee at almost a 20% premium, and the same thing seems to be continuing.
Fair point. Globally, if I look at the pattern in commodities, crude is down, cotton prices have plunged, cocoa prices have started coming down, tea prices have been by and large plateaued. So while whatever happens to crop is a matter of demand and supply, but in general, do you think the demand for soft commodities is down?
Actually, the demand for coffee is still increasing. There's a growth rate of now almost 5 to 6%, which is there across the world. So the demand for coffee is actually increasing.
Demand I'm talking about, let's say, see, India is growing, but within that, the GDP number changes depending on the curve of the economy. So coffee demand per se will grow. But in terms of the trend of demand, supply, production, do you think there could be near-term softness in the price? Because other commodity prices have also come down.
So that near-term softness within India is unlikely to happen because the demand is far higher than the supply that is there. But again, the global prices are what actually determines terminal markets. The two largest producers for, say, Robusta in the world will be Brazil and Vietnam, Vietnam being the largest. And when the crop in Vietnam is coming down by around 10%, so naturally that will have an impact on the global prices as well.
Vietnam has total production of the world capacity, and what is Brazil in terms of the total capacity?
So total capacity, I'd say about, I don't have the exact numbers with me, but more than around 15% is coming from Vietnam. And Brazil will be following maybe around 10% or so. And then the rest of the countries follow.
The pattern in the rest of the world, we've spoken about Brazil higher, Vietnam lower, that's 25%, there is 75%. What happens there?
So for the balance 75%, there are several other countries which are there, let it be an Indonesia, a Colombia, India, Africa. So several other countries fall within the balance 75%.
Within coffee category, there are a lot of categories. There is instant coffee, there is gourmet coffee. I mean, coffee is something which is becoming very driven by taste and in terms of the proposition. Which are the categories within coffees which are growing?
So actually, both categories are growing. It's broadly divided into two main categories. That is, when you're talking about in large volumes, it is your roast and ground segment, and then you have your instant segment. Both these segments have a premium range and an economic range and all that, but these are the two broad segments. Today, with the opening of new coffee shops and the demand that is coming from coffee shops, even the roast and ground segment is growing. And the instant in-home segment is also growing. So it's actually both segments that are growing at a good, healthy pace. Developing countries, the growth is significantly higher than the developed countries at this point in time. We're seeing some degrowth in some developed countries like US, for instance. But in China, again, the growth is there. In India, the growth is there. In a lot of Asian countries also, the growth is there.
Fair enough. Also wanted to get in a perspective from you then in terms of, how you're really protecting yourself from the, I wanted to get in your view on the upcoming capacities. If you could just walk us through what exactly is lined up for India SDC, Vietnam, the FDC capacities. Can you tell us a little bit more?
Yeah, so we are currently at around 55,000 tons of production capacity. By next year, June, July, we will be at about 77,000 tons. We're building a spray dried capacity in India, about 16,500 tons, which will come online by March. And we're building a freeze tank capacity of almost about 6,000 tons in Vietnam. And as far as the first question is concerned with respect to the impact of raw material on our company, we work on mainly a cost plus model. So it will, whether the prices go up or down, there's no real impact on our profitability or on our growth. So it's only the top line that will accordingly go up or down.
Can you tell us a little bit more about your growth projections? Because the company has guided for a 20% revenue CAGR over the next couple of years. Are you revising your guidance or does this hold?
No, we are maintaining the same guidance.
And what is going to drive your growth down the line? Some of the key levers?
So a lot of new markets that we're getting into, existing customers also, we've been increasing our volumes. In fact, it was COVID that actually put aside or delayed our expansion plans. So that was the main reason. Otherwise, we would have expanded a little earlier itself. Now we're just playing catch up for the demand that is already increasing across the world.
On board. Thanks much for taking time out and joining in. That's the word from the management of CCL Products. Global demand is increasing and they are seeing as of now the coffee coming in at close to a 20% premium in India. We'll take a short break right here on the show. Be right back with lots more.